So we are talking about adjusting and non-adjusting events, right? Adjusting events are events that provide evidence of conditions that already existed at the end of the reporting date. Non-adjusting events, however, these are events that have occurred due to conditions arising after the reporting period. So let's talk about accounting for adjusting events after the reporting period. IAS 10 states that if an entity obtains information about an adjusting event after the reporting period, it should update the financial statement to allow for this new information. IAS 10 gives the following examples of adjusting events. And so this is an example. The settlement after the reporting period of a court case confirming that the entity had a present obligation. Present obligation. Very, very important. The condition should have existed at the end of the reporting period. So if there's a settlement after the reporting period of a court case confirming that the entity had a present obligation as at the end of the reporting period as a consequences of the case. So that's an adjusting event. The receipt of information after the reporting period indicating that an asset was impaired at the end of the reporting period. The receipt of information after the reporting period indicating that an asset was impaired. So that's how you look at adjusting and non-adjusting events. I hope that makes sense. That's what you're trying to do in the past question the other time. When it comes to non-adjusting events, we need to talk about disclosures. Hey, why do I have so many things to cover today like that? We need to talk about disclosures. So disclosures for non-adjusting events after the reporting period. Non-adjusting events after the reporting period are treated differently. A non-adjusting event relates to conditions that did not exist at the end of the reporting period. Therefore, the financial statement must not be updated to include the effect of these events. So that's the difference. So a disclosure is required for a non-adjusting event. You should not necessarily have to make changes to the financial statements. This information should be disclosed as in a note to the financial statements. IAS 10 gives the following examples of non-adjusting events: a fall in the value of assets after the reporting period, the acquisition or disposal of a major subsidiary. All these things occurring after the reporting period. The destruction of a major plant by a fire after the reporting period. There's no indication that we could tell that a fire was coming, before the reporting period. So that's a non-adjusting event if it happened after the reporting period. So these are examples. So what are some of the procedures aimed specifically at identifying subsequent events? The auditor should actively look for subsequent events. Very, very important. They need to understand management procedures for identifying subsequent events. They need to make inquiries. You need to make inquiries, and you need to obtain, again, written representations from management in respect of subsequent events. There's also what we call facts that are discovered after the date of the audit report. And before the financial statements are issued. Even after the date on which the audit report is signed, the auditor retains some degree of responsibilities for events of which he becomes aware up to the time financial statements are issued. So at the time that audit report is signed and at the time the financial statements are issued, we looked at it in our past question, something similar in the past question last week. At the time that the audit report is signed and at the time this is issued, there's also a gap there, and the auditor has some degree of responsibility on events he becomes aware of during that period. He's not required to actively look for subsequent events. He's not necessarily required, but he has some level of responsibility. So what is his level of responsibility? His level of responsibility is therefore much reduced compared with the period before the signing of the audit report. You know, it's very, very important. So there is a year-end date or a reporting date for the client, right? It could be 31st December. Then there's a signing of the audit report, and there's when the audit report is actually issued. So these are three key dates that you need to keep in mind. So if the auditor becomes aware, and I suggest you go through the past question we looked again to bring everything to light. If the auditor becomes aware of a fact that had been made known to him, what he needs to do is discuss the matter with management, determine whether the financial statement needs amending, and inquire how management intend to address the matter. You know, if these financial statements are amended, they'll carry out the necessary audit procedures on the amendments and extend their review of subsequent events up to the date of the new audit report. So again, there are three key dates here. Number one is the year-end date. It could be 31st December. There's a signing of the audit report and there's the issue of the audit report. Issue of the financial statements, sorry. Issue of the financial statements. So these three dates are very, very important. And the auditor has responsibility. Here we are looking at the facts discovered after the date of the audit report and before the financial statements are issued. There's some small time frame within that. What about facts that are discovered after the financial statements are issued? At this stage, the auditor has no obligation to perform audit procedures or make inquiries regarding the financial statements after they have been issued. However, if they become aware of any facts, you know, that if they had known would amend the report, they should discuss the matter with management. They should determine how the financial statement need amending. Basically, they should discuss with management. You know, they should discuss with management how to approach it and how to handle this. Now let's look at going concern. Going concern. Going concern. You know, what are the objectives of the auditor when it comes to going concern? The auditor needs to find out, is there material as uncertainty that casts significant doubt? Here we are looking at, is there anything that casts significant doubt that, you know, the entity will not be able to continue as a going concern? So we will look at some of the things that cast doubt. That cast doubt. You know, but before we do that, let's talk about the duties of the auditor. You know, when it comes to going concern. You know, the auditor certainly must have a discussion with management when it comes to going concern issue. They should determine whether the assessment identified any relevant events. Yeah, this again talks about discussion with management. But let's go to the things that cast doubt or raise issues, going concern issues. It could be financial or operating, right? So financial could be adverse key financial ratios. So when you see that all their financial ratios are bad, when they have a net liability position, their liability position is red, bad, it's very bad. If you see indications of withdrawal of financial support by creditors, that casts doubt. In terms of operating, if you see things like labor difficulties, like strike, workers are not getting paid, you know, if they lose a major market, a key customer, all those things can create going concern issues, and they cast doubt on the going concern of an organization. Very, very important. Now, what are some of the audit procedures when you are doing going concern? Going concern. You cannot talk about audit procedures without having a discussion with management. So you need to find out from management. Once you talk to management, you get a vibe whether this company is actually going to survive in the foreseeable future. Another way is you need to look at their cash flow forecast. Cash doesn't lie, So if you look at their cash flow forecast, you should be able to tell. Another way you can tell is reviewing their revenue book or their sales order book. If their sales order book is showing a decline in sales orders, that's a problem. You can review their agent receivables. You can check out for litigation. If creditors are, constantly suing this company because they haven't paid them their money, that's also a red flag, That's also a red flag. So these are some of the audit procedures. Number 1, discussion with management. Number 2, obtaining the cash flow forecast. Number 3, reviewing the sales order book. Review age receivables and all that. So this is where we will bring today's lecture to an end. Thank you for joining. And if you have any questions, let me know. Otherwise, we can call it a day. And for those in strategic case study, we'll do our class at 6 p.m. on, God willing, Tuesday. 6 p.m. Tuesday, because apparently there's a corporate reporting class on Monday at the same time. So we have to move it to Tuesday, 6 p.m. Any questions? Okay.
No, sir.
If there are no questions, then I'll post the slide on the group and then see you next week. Thank you.
Thank you, sir.